for you and your family's needs. So Heritage Companies is not just an insurance agency. We are a specialty boutique agency that focuses on employee benefits. And we have clients that range in size from 2 to over 1,000 employees. So we cover the entire range of sizes. Just this morning, our agency partner, managing partner Jacob, was having a conversation with a 5,000 plus life group. So we're fully prepared to handle groups even in that space as well. So in preparation for today, we had assembled kind of a benefits guide for small employers and nonprofit organizations. I would never presume to say that I could tell you everything you need to know in one conversation. But I think we can give you a good overview of what it's like to delve into offering employee benefits, perhaps for the very first time, or maybe to explore some ways to do it differently than you have before. So I'd like to get started by introducing my team. Before we jump to my screen share, both of my, I invited our managers of our small business department to join us today. That is Justin Powell, if you want to raise your hand and wave, Justin, and Megan Corlew. There she is up in the top center. So they oversee and direct our small business unit, and their specialty and professional focus is on groups predominantly in the 2 to 10 space. And so they are uniquely structured and suited to receive your calls and emails and walk you through the benefits that are available for groups in that space. So having done that, I think I will go ahead and cut to screen share. And that's just a recap of Megan, her bio, and Justin, and myself. And this document's going to go out to everyone, I believe, who is in attendance today after the fact. So you don't need to try to read all this as we go over it, but I did want to have some talking points on the screen. I'm going to minimize the little picture on the side button so I can see my whole document. So I thought it was interesting this morning, one of my local friends here in our community, and we are housed in Belton, Missouri, by the way. One of my friends in the community, he's also in a different arm of the insurance world, and he posted he's really good at creating discussion topics in the social media space, which when that space can be often unpleasant at times, he's really good at generating really good conversation, or just sometimes something for a good chuckle. And today he said, poorly explain what you do for a living. And I can tell you some of the responses have been quite hysterical. So I thought, well, I've got to jump in and participate too. So my answer was, I help people buy something they don't really want, they don't like, they don't understand, and hope they never need to use it, but we all have it. And the people who know what I do for a living, I got LOL emojis or nailed it. And so I thought, what a better description and kind of a good lead into our conversation for today. I'm going to take a minute or two and give you a quick background on Heritage Companies and why we were invited to present this information today. Heritage Companies was founded by my very good friends, Mike and Sherry Sanders. Mike was, he was with Prudential Life Insurance Company for well over 10 years as a manager, and in the life insurance space, he often found himself giving advice to small employers about insurance, not just life insurance related and other benefits, and he came to realize they had a lot of questions and a lot of unmet needs in how to properly and effectively offer employee benefits. And so Heritage Companies was born. I was literally their original hire. And my early days of going to work were going to work in their basement in cutoff shorts and flip-flops. The good old days. And Mike's value statement and philosophy and approach to growing the business over the years was to just almost to become an extension of the small business community that we served, and just provide really excellent service in a way that did not exist in those days in this industry space. And we literally still have some clients from those earliest days. Some of my clients I've known over 25 years, which I think is extraordinary. And I love that. And I love that they've grown and we've grown together. And now we are approaching, I think, 30 employees in our office space here in Belton. 2.5 years ago, Mike and Sherry made the decision, as they were approaching retirement age, to seek interested, possibly buyers for Heritage. And we were acquired, friendly acquisition, by Acrisure, which is the 7th largest insurance brokerage in North America. And they are literally the best of both worlds, because, you know, when you're getting a new parent company, especially for a small local agency such as we have been, what does that look like? What is that going to feel like? Is everything going to change? I think all of my colleagues would back me up when I say it feels exactly now like it did then. They largely are in the background and leave us alone. We have begun using their IT systems, phone systems, network, and things of that nature. But basically their model is to buy successful agencies and then leave us alone to keep doing what we do best and what made us successful in the first place. We get access to their very large legal and HR corporate teams when we have clients that have some unique or challenging needs. So not only do we, but our clients benefit from that relationship we have with Acrisure. But for day-to-day operational businesses, Heritage is still Heritage. So enough about us. I'm going to just kind of jump in. I'm going to keep this pretty conversational. I'm not going to have it very formal. I think better learning and better information exchange occurs when we just have a casual conversation, much like I would do if we were sitting down right now across a desk or a table from one another. So as I was assembling this information a month or so ago, I really wanted to just kind of separate some thoughts and walk you through things you might not have considered before, particularly if you've not offered benefits to employees before at all. So we always advise to start slow because there's usually no going back once you offer benefits. Nobody wants to be that employer that we had a great year and we're finally ready to do this, and you offer benefits, and then maybe due to market fluctuations or instabilities, you have to now take that away. So you want to think about that. You want to realistically budget for, plan for, and consider what you can offer. You can always just start with one benefit, maybe medical, or maybe medical's too expensive and you want to start by offering dental and vision and maybe some life insurance, and maybe medical is a step 2. Sometimes we advise clients to take a walk, crawl, run approach. So again, starting slowly and working our way into it. You want to work with a good broker who's going to accurately help you assess the true cost of each benefit. You don't have to necessarily absorb 100% of the cost. There can be cost sharing, certainly, but when you land at whatever those percentage cost splits are, you want to annualize that out times the maximum number of employees that may be eligible that you're now matching this for. Some might waive the benefits, some might elect them, but I think it's always wise to look at your, I hate to call it a worst case scenario, but your highest cost scenario, for example. So what if every full-time benefits eligible employee elects, and what is our cost share? The rest of it will be captured through payroll tax deductions for their part, but you're absorbing your part in paying that. So you want to annualize your costs and plug that into your budget to see what kind of flex you have in that space to begin offering. Also, don't just look at what other peer companies are doing, or your brother-in-law or your cousin's best friend's uncle who has a business kind of like what you do, and what do they offer? They may be many more years into their industry and maybe further along in their benefits offerings. So benefits can be uniquely customized for almost every size of company and every budget. I can't tell you how many times over the years I've had, when we're bringing a renewal or options or new plans for consideration to either a prospect or a client we've had for a really long time. And when rates go up, everybody gets upset, us included. We ourselves took a 28% rate increase this past year. So we are not immune from getting increases as well, but we'll have people say, well, my sister works at a company and they have a Blue Cross plan and they pay a lot less than this. Well, what they don't realize is the sister's company may be much larger. For example, they may be in a self-insured plan basis or a large group fully insured plan space. And so all these insurance companies compartmentalize the different products they offer for groups who are in different industries, different sizes, and all kinds of different factors go into determining each group's rates. So there is no cookie cutter plan per se. The next thing is that when we think about employee benefits, we immediately go to medical, dental, vision, life insurance, and that is our space. That's what we do. But there are always certain required employee benefits that every employer, unless you're in an industry that's exempt from these, but there's Social Security and Medicare taxes, there's unemployment insurance. Some states do require disability insurance. Missouri or Kansas is not one of those. FMLA is another one for employers of 50 or more people within a 75-mile radius of the work site. So those are employee benefits, and there's a cost to the company. And so those should not be minimized or discounted. They are part of an employee's total compensation package, just like medical, dental, vision, life, and disability benefits can be. So that takes us into some common employee benefits. And I color-coded these not for any other reason other than to just have some separation of sections. So medical insurance is usually the most important insurance benefit to employees. That's the #1 protection they're looking for themselves typically, or their dependents as well, depending on the work and benefit situation of their spouse. I can tell you some employers do indeed pay the entire health insurance premium for the employees, but that is the exception. Most pay a percentage of the per employee rate, with some employee cost sharing, which is recaptured by the company then through those payroll deductions. And we'll talk more about that later. So I just had a conversation with a brand new small group in the past week who is doing their very first hire. And they literally did not know how to recapture the employee's portion that's above what the company is going to pay for. And that's nothing to be embarrassed about if you haven't done this before. But I just explained to them, they will pay the whole bill to the insurance company, which happens to be Blue Cross and Blue Shield of Kansas City. And then they recoup the part that they don't want to pay for, the part that is the employee's responsibility, by deducting that out of their paycheck. That's how they keep that amount. And we talked through that a little bit. So there's little nuances to learn and understand. And then, if you're working with Support KC with your HR services, they certainly are familiar with that as well and can help in that area. So the Affordable Care Act rolled out in September of 2010, and it certainly added brand new complexities to healthcare benefits, including who must offer benefits, meeting certain affordability thresholds or requirements, and much more beyond that. So any employer under 50 is not required to offer benefits at all. Of course, many do so in order, they want to be a business who's able to do that. They want to use it to attract and retain a skilled and invested workforce. So there's lots of reasons to offer benefits, but if you're under 50, please know that you don't have to. Federal law does not require you to. A sub-point there, setting up a premium-only cafeteria plan document. Many of you've probably been on perhaps corporate plans, or your spouses have been on plans that offer a cafeteria plan. Flexible spending account plans are one part and a popular part of a cafeteria plan, but premium only is something that's been in existence for a long time. It's called a POP document for short, premium only plan. This is the document that you need, and it allows the employer, you the employer, with employee consent, to withhold their paycheck portion, that portion of any medical, dental, vision premium they're going to cost share with you on, do that on a pre-tax basis. This is an attractive thing to do, and it benefits both the employee and the employer because it reduces payroll taxes for your matching part as the employer, and it reduces their taxable income come tax time. So it's almost assumed that everybody does this now, but we learn all the time that still not everybody knows about this, but we will always advise our clients to take the small step of having a very inexpensive, updated, legal and compliant POP document created if you're going to offer an employee benefits plan. Other popular benefits, the most common ones, particularly in small company size this space, would be dental and vision benefit plans, and then often a small amount of life insurance, which is referred to as basic employee life. And typically the employer does pay 100% of this small life insurance benefit. It's a flat benefit. Voluntary life can also be offered depending on the size of the group and how many employees enroll in it. If employees want to purchase life insurance coverage conveniently through their work benefit place in addition, but this is a very popular, very common, almost always offered benefit. And again, $20,000 is a pretty typical amount, especially for small groups. I have a few groups who get really crazy generous with this. Some of them do 1 times annual earnings. I have a couple of groups doing 3 times annual earnings, which is really generous and highly uncommon. But this is often thought of as a simple death benefit. As much as it's talked about in every space, TV, social media, everywhere, I can tell you there are still tons of people that don't even have a basic life insurance benefit in place. And then when something happens, the worst case scenario happens at a time when family members should be grieving, they're scrambling to cover basic funeral expenses, and you see GoFundMe accounts and things of that nature set up online. So we do always talk about and advise employers to consider offering a simple basic employee life benefit. So now I'm going to switch over to another way small employers, even larger employers, can possibly pursue being able to offer benefits. We don't consider this as a best practice necessarily, but it can be the right choice for some companies. And so we would never just completely disregard the value or the place for a PEO. A PEO is a professional employer organization. Is it right for you? These are organizations that they're very similar to, in some ways, to Support Kansas City, in that they help you manage your HR services, payroll, and a lot of them offer an employee benefits package that you can select from for your employees. And there's both some total combined group and individual group underwriting that goes on that helps determine the rates that you get in that space. PEOs pool together small businesses to offer big company benefits like medical, dental, vision, and life, like we've been talking about, often for a lower cost, but I'm going to put a big caution sign here and say not always. PEO services vary greatly in the price you pay per month, which is a per month per employee for all bundled services. So you're going to have your meeting with them. You're going to determine which services you want to contract with them. And they're going to come up with a per employee, per month fee based on all the things you want them to do for you. And then on top of that would be the benefits selected and offered. You would still have your company cost sharing towards the benefits, and the employee's portion is still captured through payroll deductions that they're handling for you. My caution here is to just always ask for and thoroughly study to understand the full breakdown of your costs when considering any PEO offer. There are some really great ones out there. And I just want to say, as with any industry, there are some out there that I unfortunately, I consider to be less than completely transparent and honest, and they'll stack a lot of hidden fees inside there that it can cost a lot to get out of, or you find that you're actually way overpaying for benefits. So if you know what you're buying and it's all laid out and transparent, it might be a great fit. So I would never say don't consider it at all, but I would say take an eyes wide open approach. So this is by no means conclusive or precise, but I did some sampling across the board, and predominantly in our area, to just give you a range or an idea. So again, health insurance, medical insurance being the most #1 desired benefit. Employer typically shares the cost with employees, such as 50-50, meaning I use an example of 500 and up for a typical cost for employee on the right. And I'm not going to lie, it can be much higher than that, and I'll explain why in a minute. But let's say somebody's rate is $500 for employee only. If your cost sharing arrangement, and you've got to be the same with everybody, or you can get into discrimination space. So you want to be consistent across the board by class of employee at a minimum, if not all employees. So that means of a $500 rate, the company would cover $250 of that $500 rate per month, and the employee would have a $250 monthly cost share, and that would be divided out in equal per pay period cost shares. So for instance, if you have, if the employee's portion is $250 a month, and you are a company who has 26 pay periods, you're going to take that $250 divided by 12 months in a year, and then divide it by 26 equal pay periods, and that's your equal per pay period amount that comes out of their paycheck. So again, 500 and up is an average representative. It can be very different, and we're going to talk more, I said can be much higher on ACA plans, particularly with older workforce. So ACA plans are Affordable Care Act plans. They are community rated. They're the most common type of plan that small groups under 50 are on now. And these plans are rated without any regard towards medical underwriting. We call them the rates or the rates plans. So each insurance company who wants to offer compliant healthcare plans in a small group space under federal Affordable Care Act laws files plans a year in advance with the insurance departments of their states. And so Aetna does this, Blue Cross does this, Cigna, Humana, United, for example. They file the plans and the rates a year in advance for review and approval, so then they become fixed and finite. And all of these plans have what is called an age rate grid. So from age 0, children, obviously, 0 through 14 is the first age band. Then there's a rate for a 15-year-old, a 16-year-old, 17, 18, 19, 20, 21, all the way up to 64 plus. So there's a fixed rate per person, whether you're the employee, a covered spouse of an employee, or covered dependent children. And covered dependent children can be covered up to age 26 on all plans. So that's the way Affordable Care Act plans are rated. We'll talk a little bit later. I'll get into a deeper dive on comparing these community rated plans versus some of the more old-fashioned plans where we get into applications and medical underwriting review. And for health for healthy groups. That is a way to get your rates down pretty substantially. On an Affordable Care Act plan, it's not unusual to see a 60-year-old rate be in the $900 to even $1,500 range. So that's why I say and up. Dental insurance, employers may contribute or employees can pay all. In an instance where the employer is paying 100% of the benefit, then all employees are expected to enroll because 100% of the premium is covered. When you cost share this out, then it's just simply called, it's still an employer-sponsored plan, but it's contributory and the employees are contributing some of that rate. If you make it a voluntary benefit, then the employees are paying 100% of that benefit. A common strategy for small businesses is for the company, at least getting started, is to put your money towards the medical benefit and then offer dental and vision on a voluntary basis. Again, it's important to be mindful when setting this up, and that's where Megan and Justin would talk to you if you approach them to get some quotes and consider this further down the road. Often on a group that's under 9, you've got to meet some kind of participation requirements, especially if it were under 5, you may have to have 100% participation on a group that small. Each carrier can be slightly different, and they'll know those things when they're getting quotes for you and then doing a review with you. Over to the side, depending on the type of dental plan and how minimal or how rich that plan is, a typical range is $15 to $30 per month per employee on average. That's a good range for a lesser plan versus a pretty full plan. Some plans, really rich plans, they can get in the $40, but we can almost always find something better than that. Vision insurance, same explanation as dental, can be offered with the employer cost sharing with the employee or voluntary and the employees covering that. $6 to $10 per month is a pretty good range given the type of vision plan selected. So in the next section, I go over a little bit just how does small business health insurance work? And I identified 4 main elements that we think it's important for a business owner to be aware of concerning small business health insurance. And those are coverage, number of employees, employee premiums, and shopping for coverage. So let's just touch on each of those briefly. Coverage. Under a small business health insurance plan, coverage is guaranteed by the insurance company when offering a community-rated Affordable Care Act plan. That means you, your employees, and dependents cannot be denied coverage based on pre-existing medical conditions. All eligible employees, eligible being full-time, working 30 hours or more per week, and their dependents, can enroll in the new plan regardless of their medical conditions. That is the reason why Affordable Care Act community-rated plans were created, to find an option that was not based on medical underwriting. But that is also why the rates are fixed and finite and higher on average, because they have to cover everybody regardless of what's coming onto that plan, whether they're healthy or not. Number of employees. To qualify for small business health insurance, you must have at least, this is 1 employee on your payroll, and really it's 2 employees on your payroll. This is where getting into conversation with Megan and Justin becomes important, because eligibility rules can vary slightly. So a company will recognize that the owner of a group is an employee, but they may not be necessarily on payroll. They may be being compensated through profit draws and things of that nature, but you're going to always have to have at least an additional, so we can't do groups of 1, and I do not want to imply at all that we can do a group of 1, but you've got to have at least an additional employee, a W-2 payroll employee on your payroll. So depending on whether you're on the Kansas side or the Missouri side and which carriers you are considering for plans, that's where we get into the nuances when we approach any broker you choose to work with, whether it's our team here or anywhere else. It is up to the broker and their team to know the appropriate underwriting guidelines and eligibility rules for the site of the state line that you're on and with the carriers that are being considered. Employee premiums. This is a both yes and a no. It says you must pay at least 50% of the monthly health insurance premiums for employees. The employee, however, can be required to pay 100% for any dependents they may cover. So I want to clarify this a little bit. If you are choosing to offer an Affordable Care Act plan, by virtue of the fact that you are under 50 and not required to offer a plan at all, you are not required to meet affordability rules, and you could have an employee paying more than 50%. The carriers kind of turn a blind eye to that because the federal government doesn't have a fixed and finite rule on that for the under 50 space. You may not get a lot of participation on the plan if you're not doing that, but when you are offering an Affordable Care Act plan, you are federally not required to meet 50% of that monthly premium. However, if you work with your broker to move out of the community rated plans, the ACA plans, and want to try to get into more affordable plans that do require medical underwriting applications, if you shift over to what are called the level funded plan space, you do have to contribute at least 50% of the employee's monthly rate. So I just wanted to be really clear on that. And that's where I can never cover all of this adequately nor effectively for you in a talk space like this today. That is an additional conversation to be had with one or more brokers as you're moving towards actively contemplating this or trying to implement this. That's the time you would go over all these little nuances and rules. But I did want to touch on it so that when you get this document and you read through it again, I want that to make a little bit more sense. Sometimes there's just not enough room on a page. I could keep writing this document and turn it into a 50-page research paper and then no one would read it, right? So shopping for coverage. So with the community rated plan that I keep referring to, you can shop for health insurance rates at any time. You do not have to wait for your current plan to expire or a special open enrollment period, and you can cancel the plan at any time in writing and shop for a different plan off renewal. So maybe you are already on a community rated ACA plan right now and you just hate the plan. You are not required to keep that plan until your renewal date. Maybe your renewal date is December and you'd like to do something right now or just at least see if there's something better. You can. So you do not have to wait to renewal. The insurance company is locked in for those rates for your 12-month plan year, but you are not locked in. So I just want to make sure everybody is aware of that. It is a little different though. If you are on a level funded plan that I just referred to, you are typically locked in for a 12-month contract. It can vary a little bit from carrier to carrier. So when that contract is up, you have the option to renew it or shop for a different plan, and your broker and their team would handle this process for you and guide you in the review process, the decision process, and implementation process of changing if that's what you want to do. A good employee benefits broker is going to walk you through that entire process and make sure you understand what your options are and how they each work, whether you're considering a community rated plan or a level funded plan. Level funded plans were developed by the insurance companies who offer plans in the small group market as a way to get healthy groups out of the community rated plans. The community rated plans just aren't as rich. They have to be a little bit cookie cutter. They have to be a little bit one size fits all. Typically, the deductibles have to be a little higher and the out-of-pocket limit amounts are higher to help with the affordability factor. Remember, these plans are uprated because they're already built in to cover any imaginable healthcare condition that may be present on any group that joins them at any time. They could have a group join them on June 1, and before the first month of premium payments is even out, they may be having to pay out massive claims on somebody with a very critical healthcare condition. So these rates are higher for a reason, because they cover everybody without regard to rating up, versus the level funded plans, they'll take a group through their own unique underwriting process and effectively rate a group correctly based on their collective group health and demographic data. So I'm gonna do just a little bit deeper dive on these two types of options. Again, we have health insurance plans versus health reimbursement arrangements. So these are options for businesses with 2 to 50 employees. Fully insured plans, that is exactly what I've been talking about with the Affordable Care Act, community rated plans. These are the most commonly offered insurance plans for groups in this market, or they have been at least since the rollout of the Affordable Care Act back in 2010. The company or the employer pays that monthly premium, that's the total bill for all people on the plan, to the insurance carrier, and the insurance company pays any claims that come in for any covered member on that plan. Members of the plan will always have some manner of an annual deductible to meet, and also a maximum annual out-of-pocket limit. Most plans also are going to include office visit and prescription copays. So those are the three most member cost-sharing buckets. The most common ways people use their plans are those copays. Going to your family provider or a specialist for that office visit, or picking up some prescriptions a few times a year, or even monthly if you're on maintenance medications. Those are the number one ways people use their plan. If you get into more serious medical care needs, you may be having to meet some or even all of your deductible. And then once deductible is satisfied, that third bucket is called coinsurance. That's where after deductible, it's an 80-20 or 70-30 or 50-50. So that percentage is your coinsurance, and it's that plus your copays is what takes you all the way up to potentially meeting your maximum annual out-of-pocket limit. So your annual deductible might be $2,000, but with your coinsurance cost share and your copays, if you're a high-end user of your medical plan, you may have, for instance, a $7,000 annual out-of-pocket limit. That's the reality of most medical plans these days. So under the Affordable Care Act, these community rated plans, to touch back on the point I made in the previous section, they have a rate grid of premiums for every age of every enrolled participant. Again, that's from age 0 to age 64 and up. Plans and rates, again, they're filed by insurance companies prior to the current plan year. They're set, they're final, there's no negotiation on the rates for these plans. There's also no medical underwriting and no pre-existing condition exclusions. The guaranteed coverage, regardless of health cost of these plans, is higher. As I've said repeatedly, the average renewal increases for these plans is typically, and this is on average, 6 to 15% each year. So it's fairly static, and I've seen that. So not only are the rates filed from year to year going to be some percentage higher, remember on these rate grids, we move up in rate grid every single year. This year, somebody who's 34, but next year on the renewing plan, they will be in the age 35 bracket, and the next year on the 36 bracket. So rates walk up two ways, one by the plan, and second because you're a year older every year. Level funded plans, again, recently popular, and carriers began offering a way for healthy, smaller companies to try and qualify for better rates rather than the fully insured plans. To qualify for these kinds of plans, eligible participants must go through a medical review process. That means filling out applications. Healthy groups can qualify for lower rates, which is better for both the company / employer and better for employees. Everybody's paying less. So if the group together can successfully medical underwrite, you may be able to get slightly better or a lot better rates than you can in the ACA environment. And also potentially offer even a better plan. Maybe you can afford a better plan at better rates than you could with the ACA plan rates. So lower rates are offered when that group is healthy and claims remain low. So in other words, only a company of healthy individuals should consider level funding. If you're the business owner and you know you are aware of yourself of a mid-level to something chronic that's being managed, such as diabetes or a major medical event going on like heart disease or cancer, you would not receive favorable medical review in a level funded scenario. Sometimes, well, actually, I feel like a lot of times, even though employers aren't supposed to know about their employees' health conditions from an employer standpoint, let's face it, most small companies are like family, and you know about things like that, but you've got to kind of wear two different hats, from friend and you care to employer separate. But so sometimes what I'm trying to say is you may be very aware of your employees' health conditions, and sometimes, believe it or not, you may not at all. I had a client last year get a really terrible renewal, like 30%, and she would not accept from me that there were major medical issues going on in the group. Now, the insurance company, because they're a small group, they don't give me details, but they can say you have an active claimant right now with more than $150,000 in medical claims. You have another claimant who's on a $15,000 a month prescription medication. You had another one that just had a $50,000 claim. And she was like, I would know these things. My employees would tell me these things. And clearly her employees were not sharing these things with her. And it was very hard for her to accept that they had that amount of medical conditions present in the group and that kind of claims happening on the medical plan, but it was true. So rates reflect medical history, but there is still no exclusions for pre-existing conditions. So small group space, nobody can be excluded or not covered. They're going to raise the rates that they would otherwise offer if there are medical conditions. And after they go through medical review and come back with a final set of quoted rates for you to consider, the rates may not be any or much better than what's available back up on the community rated side. But sometimes even bad rates in the level funded side are still better than the best rates on the community rated side. They can be that different. Another nice feature in the level funded side of things is that if you have a plan that's running really well, a portion of your premium may be returned to the company at the end of the plan year if there's a surplus in the claims fund, and after the run out period, usually it's a 90-day run out period. Sometimes it's 6 months, sometimes it's longer. Each carrier is different with what they consider their run out period for all claims of the prior plan year to finish running through the plan and be paid out. But we do have many, many clients who run well. They are fortunate to have a healthy workforce, very low claims. I have a client who has about a $23,000 a month bill with Humana, and they had such a successful year with low claims this past year. They got about a month and a half worth of no bill from Humana. They got that much money back. It doesn't always happen, but it does happen. So now I'm going to shift gears into talking about an ICHRA. I love some of these acronyms in this industry. This is an individual coverage HRA. So this is one way to provide a kind of health benefit for employers of all sizes. It's typically more popular in the small group space. I personally think there are more benefits to seriously looking at group plans, but sometimes and for some people, they're more comfortable with doing this. So this is where you have to have at least one W-2 employee, and employees participating in the ICHRA must have an individual health insurance plan. I see I left a word. Well, no, they must have individual health insurance. So they've got to have some kind of marketplace individual health insurance plan, or they can't participate in the ICHRA. And this is where, with an ICHRA plan, the employer can reimburse employees tax-free, and that's the benefit, the reimbursement and tax-free for individual health insurance premiums and other medical expenses. So we have a lot of employers out there who really want to do something for their employees, and they want to be able to reimburse them for some expenses. And they just start saying, well, I'll just give you, a bonus to cover, since I don't offer a group health insurance plan and I don't think I can for a while, I'll just give you a bonus each month to cover that. Unless you have an ICHRA plan document in place, you're technically engaging in what is a non-compliant and non-legal group health insurance plan. It's non-ERISA compliant. So if you're doing that, you need to work with a broker or a third-party administrator to get even a very basic, simple ICHRA plan. Yes, it's an IRS rule, and yes, they're annoying, but it's in violation of IRS and DOL guidelines to do a reimbursement without a legal document, because otherwise they're getting inappropriate compensation. So a couple more bullet points here. S Corp owners and spouses who own more than 2% of a business cannot participate in an ICHRA, as owners can write off medical expenses through other means and are not considered employees of the business per IRS regulation. I am not an accountant. I am not a tax advisor. So some of this stuff is just me knowing, understanding, and repeating the facts. I'm not qualified to give actual IRS or accounting advice. I always want to make that really clear. So the employer can set a monthly per employee allowance of tax-free money. So with the ICHRA plan, that's where your compensation of this to them can be tax-free, because now it's in the benefit space. The employee submits proof of expense. That would be their monthly bill they get for that individual healthcare plan they're on. So they submit the proof of the expense. They have to incur the expense in order for it to be an eligible ICHRA expense. And then they receive the reimbursement for the expense up to the capped limit that you've declared. Employers must meet all ICHRA deadlines outlined in plan documents, including notice requirements and paying of approved reimbursement requests. ICHRAs can be self-administered, or the employer can choose to work with an ICHRA third-party administrator. I feel like I'm lisping when I'm speaking some of these sounds. So I advise that it can be highly beneficial to work with a knowledgeable third-party administrator, just because they can help make sure your documents are up to date and legal, and that you're meeting your notices to employees on a timely basis and handling your reimbursements correctly. The next one is called a Cucera, Qualified Small Employer HRA. It is a health benefit for employers with fewer than 50 full-time equivalent employees, and does not offer a group insurance policy to any of its employees. With a Cucera, employers reimburse employees tax-free for their medical expenses, which can include health insurance premiums. It allows you, the employer, to set up an allowance cap, which gives you budgetary control over costs. As with an ICHRA, S Corp owners and spouses owning more than 2% of a business cannot participate in a Cucera for the same reasons cited under the ICHRA plan. Now, the Cucera does have maximum limits, and those are cited here in this space, whereas an ICHRA does not. It allows an employer to avoid having to qualify for a group health insurance plan, going through those steps and the associated costs and responsibilities. There are still, however, costs and responsibilities, so I'm not sure it's honestly that much different than going into a formal health plan. It gives employees the power to choose how they want to use their allowance. Can be used for premiums or out-of-pocket expenses. There are 200 plus eligible expenses for reimbursement through a Cucera, including premiums for individual medical, dental, vision, or even long-term care plans, co-pays, deductibles, prescriptions, chiropractor visits, for example, on the plan that they may have. So the employees submit proof of expense to receive reimbursement up to the Cucera plan limit. Employers must establish legal Cucera plan docs, including a summary plan description, to comply with IRS and Department of Labor requirements. Employers must meet all Cucera deadlines outlined in the plan documents, including notice requirements and paying of approved reimbursement benefits. But you've worked with somebody in setting this up, so you should have a good idea of what your responsibilities are and what you have to meet, because you would have worked with your administrator to create the plan that you want to offer. You're in control of that. Once again, it can be self-administered, or the employer can choose to work with a Cucera third-party administrator. I'm always going to advise working with a third-party administrator. I think it's well worth it just to stay legal and compliant. So as you really begin to think about, should I, do I want to, can we, ought we, think about these things. How many 30-plus hour a week employees do you typically employ in a year? Do you have any idea? Do you know how healthy is your employee pool of those eligible for benefits? How much variation in premium can you accommodate year to year? So what if you did go through the process of going through filling out applications, the broker submits them out to various insurance companies, receives back some final offers, and everybody's really healthy right now, and you get rates back that you like, and you want to jump in and offer this. And remember, on a level funded plan, you must contribute a minimum of 50% of the employee's rate. So maybe 4 of your 5 eligible employees participate in this. You're responsible for 50% of their premium. If they want to cover a spouse or children, you can set up the cost sharing requirement that they pay 100% of all enrolled dependents. If you have the budget for it and want to do some modest cost contribution sharing on dependents, you can, but you certainly don't have to. What if in the very first year of the plan, your renewal, due to some massive claims hitting that claim fund, and the claim fund is in a deficit rather than a surplus, maybe you get back a 20% renewal. Can you accommodate, can your employees accommodate a 20% increase? So those are just things to be aware of once you enter the employee benefit space, particularly a medical plan. Dental and vision plans never go up that much, typically maybe 5% at best. How much can your employees afford to pay for their cost share, if any? Would your employees rather have low deductible plans or low premiums? There's a big difference there. And lastly, just fully considering and vetting what kind of plan you're looking for. A traditional plan with copays for common everyday care, maybe an HSA qualified plan for use in conjunction with a health savings account. I'm a huge fan of HSA qualified plans. I've been on one for nearly a decade, and I could talk about those all day long, but I won't. Or are you looking for a plan with maybe a limited provider network for even additional cost savings, smaller networks, smaller rates? We are getting close to wrapping up here. Compliance considerations, that's probably the biggest part. Is you can't just pick a qualified broker and say, well, they'll handle it all. A broker will guide you through a lot of this, but at the end of the day, the DOL and the IRS considers the company as the responsible party offering the plan. And therefore you have a responsibility to know what you're offering and to know what your legal compliant responsibilities are. We say working with a qualified broker or agency is a must in today's compliance-driven benefits environment. The rollout of the Affordable Care Act brought regulatory requirements like I've never seen before in my entire career. There are so many annual notices and legal notices to employees that have to be met. We handle a majority of those documents and provide all employee annual notices free of charge, but there are additional documents, plan documents beyond that to meet DOL guidelines, which are summary plan descriptions and wrap documents. And we have access to a third-party administrator that generates those, and we nearly always provide those at a pass-through cost. So we have to pay to get those, and then we just pass that cost through. We don't add any uptick or charge for our time, but there are documents that have to be generated every year. SBCs are the summaries of benefits and coverage. Those are the new template, the federally required template of explaining every single medical plan. The insurance companies do generate those and provide them. We took those into the employee benefits package or the plan document library for clients using our online benefit management portal. All the annual notices, again, we do create all of the annual notices free of charge, and those are, again, are provided for you and your employees. FMLA notices, CHIPRA notices, GINA notices, women's health care, all of those. HIPAA, group health plan sponsors, that your company must ensure the protection of your employee data in compliance with Health Insurance Portability and Accountability Act. We apply the highest possible security safeguards and protecting data to ensure our clients are protected from liability. Erisa and Dol audits, I would not say they're prevalent, but any employer offering and sponsoring a group health plan can be audited at any time. And if you ever were to receive notice of you're going to be audited, you usually have about 10 days or so, is my understanding, to produce proof that you do have all the required documents and have offered them. And COBRA. COBRA is applicable to groups 20 and up who are subject to federal COBRA laws. That is for continuation of coverage for employees who either voluntarily or involuntarily leave a company. Once they're not an employee, they're no longer eligible, but they are eligible to pick up continuation of coverage. Groups under 20 are not subject to federal COBRA laws, but you may be subject to state continuation of coverage laws, which are similar to COBRA, but certainly not identical. ACA community rated plans do have continuation of coverage under state continuation for groups under 20, but the level funded plans are not eligible for continuation of coverage. Again, that's an important piece of information to know if you choose to offer a level funded plan. Any employee leaving would not be eligible for continuation of coverage because the plans simply don't offer it. So that is my very last point. I'm going to stop sharing. I hope you guys are all still awake. I know I've covered a lot very rapidly. As you can see, the space of employee benefits can be very complex, but a good broker, and we are by no means the only good brokers in Kansas City. There are some really good employee benefit agencies in this town, but that's where working with them, and they should tolerate you asking as many questions as you need to know to feel comfortable before diving into this space. Sometimes you simply need to get started just by asking, you know, Megan or Justin, if you're working with us, or another agency. Maybe you just need to see quotes. Maybe you just need to see what the sticker price looks like before you can even think beyond that point. So we are here to help answer questions after the fact. The document you're going to get has our email addresses and phone numbers. We welcome your calls and emails to explore if this is a right step for you to take, or maybe you're doing it and you would like a free audit of your benefit package, and are there other plans or other benefits that you can and should consider. So I'm going to be quiet now. I've talked too much.
So Holly,